Freedom Builders, and welcome to a video about stock investing. My name is Hans Nielsen and I'm here to guide you on your road to a good solid financial future. In the former videos I've been telling you about the core principles why building a good financial future is important. Today we're going to touch on a topic that I know you have been craving to hear more about, and that is a specific strategy as to how you can invest your money. This strategy is very simple. It'll take you 1 hour per year. Not per week, not per month, but per year. It is very simple, but it has been tested over the last 20-30 years and is showing quite good results. It's important for me to say in the beginning that I cannot guarantee that it'll keep giving you good results, but the core rules and the basic ideas about it are quite solid. So let's get to it, and in the end of the video you will know all about it. You will know exactly how to invest and trade with this strategy. Are you ready? Alright, let's get started. First of all, why is it important for us private investors to have a rules-based strategy? Well, history and statistics shows us that us normal amateurs, the dumb money as you know they're called, we simply underperform the market every single year, seen over a time span of 20 or 30 years. We're simply not good enough at investing. And why is that? Well, up between your ears, we have an old computer. Of course, it's your brain. The problem is that the software this computer is running on was programmed 10 or 20 or 50,000 years ago and was designed to survive out in nature. That means that when you place the same brain with the same software in front of a computer screen with blinking dots and lines, it's simply not functioning well enough. And here it is important to have a fixed set of rules that you should never deviate from. And that means that you can take your emotions and your fear and your greed and put it aside. Because what we normally do if we do not have rules is that the market starts to go up. And you remember the last time it went up and then it came crashing down and you lost some money. So you're not getting in on this trend because, oh no, I'm not going to lose money again. But then all the clever money comes in, and then your neighbor comes in and he's paying for his new roof with the money he's making on bitcoins or stocks or whatever. And then the paper starts telling about how fantastic the stock market is, and all of a sudden you give in and say, oh yes, of course I need to be in this market, because you get greedy and you're really annoyed and irritated and stressed that you didn't get in down here. And then of course the market turns, and in the beginning you're saying, well, it's just a dip, it's just a retracement, I'll just buy some more maybe even. And then it starts dropping and you're in a complete shock, and all of a sudden the pain is simply too much and you say, alright, I'll sell. And of course the law of nature is that the second you sell, the market starts going up again, and then we start all over. Amateur private investors, they simply buy and sell on the wrong times. And the people they are selling to down here are of course the professional investors that can see all the signs as to now the market is starting to turn. So all the private investors are selling here, but of course they're selling the stocks to the pros. And here they're buying the stocks, and of course they're buying them from the pros as well. So the professionals are making the most money in the market, but you can as well, and you can beat the market. So let's see how that is done. Let me first say that when I say beating the market is kind of a vague thing. But normally when I compare myself and say, do I match up to the market, I am comparing to an index. And an index is a collection of different stocks where we have some weighted average down in 10 or 30 or 500 stocks. And you can say that all of these, the average of all these stocks, we have a number for that, and that is just called the index number, or the price of the index. The index I usually compare to is something called the S&P 500. That is a collection of the 500 largest stocks in the US market. And since the US stock market is the largest market in the world, and the 500 largest stocks is a pretty good picture of the overall market, then I use that as a benchmark. But you can use other benchmarks as well, and that is entirely up to you. But let's look at the strategy. The strategy is called Dorks of Dow. And let me just explain the name here, because dorks is the stock language for bad stocks or low price stocks. And if it is really bad, it is a dog with fleas. I don't know how they came up with that metaphor, but dorks in a stock terminology is a stock that has dropped significantly in price. All right. Dow is the name of an index, the Dow Jones Index, and that is the Dow Jones Industrial Index is the 30 largest stocks in the US market. So they are huge. It is gigantic companies with thousands and thousands of employees, some of them almost 1 million employees, and they are household brands like Coca-Cola or IBM, or many of the really big companies are represented in the Dow Jones Index. So the Dorks of Dow refers to that you are buying some of the lower priced stocks in the Dow Jones Index. All right, so far so good. Let's have a look at the performance. If you have used this strategy, what would your performance have been? And the numbers I have here are not counting 2019, where we are now. We are in November 2019, but the statistical numbers I have found are up until the end of 2018, so that is the numbers. The strategy has not performed quite as well as the market this year. At this time, in November, I think the S&P 500 is up something about 20%, and the Dorks of Dow strategy is only up something like 10 or 12%. But it will not beat the market every year, and sometimes it will even lose money one year, and that's okay. There's no holy grail. It is not that you can find a strategy that will make money every single year, but this one is actually quite a decent strategy. So if you look at the stats here, we can see that over the last 3 years, the Dorks of Dow have made 14.8% per year. That means that it is 2016, 17 and 18. 14.8% per year, whereas the S&P 500 has only made 9.8%. So that's quite a difference. Over the last 5 years, the Dorks of Dow made 11.6% and the S&P 500 made 8.9%. And over the last 10 years, 15.6% as the compared to the S&P 500, 13.7. Now we are in 2019 now, meaning that if we go back 10 years, we simply just miss the big financial crisis. So if we go back even further and saying we're going back to the year 2000, we're going back 19 years here, you can see that we are getting the dot-com crash in 2000, 2001, and the stats are also including the financial crisis in 2007, 8 and 9. And here, even though we have a lot of crisis years included, the Dorks of Dow is actually making 9% per year, and the S&P 500 is only making 6.4% per year. Alright, you might think, 9%, is that really so great? And it's only 2.5% more than the S&P 500. Does that really matter? 2.5% on $10,000, it's only $250. Is that really worth it? Well, you shouldn't look at it just from 1 year. You should look at it in perspective. Let's say, for instance, look at this chart here, that we invest for 20 years. And we put $10,000 in at 6.4%, as you can see here, for 20 years. That gives us, after 20 years, $345,806. But if you have used the Dorks of Dow strategy over the last 20 years, and you have gotten 9% per year, $100,000 deposit, 20 years, that would have yielded $560,441. That is quite a difference. And if we go even further out and go to 30 years, then the normal S&P 500 with a $100,000 deposit would have yielded $643,000 almost, a bit more actually, and 9% from the Dorks of Dow would have given you $1,326,000. So that is double the amount, just quote unquote, by getting 2.5% more. So the more you can squeeze out of the market from your investment, it doesn't matter if it is 1% extra if you're only counting 1 or 2 years. But if you're investing for 20 or 30 or 40 years, it can be a massive difference. So you should be motivated to squeeze some more percentages out of the market. So let's go to the strategy and see what it is actually all about. Okay, the dogs of Dow. How do you invest with this strategy? Well, the good thing, as I mentioned in the beginning, is that it only takes you 1 hour approximately, maybe only 15 minutes per year. It is a very simple strategy. And the reason, as I mentioned, it's called Dogs of Dow is that you only have to look at the 30 largest stocks that are in the Dow Jones Industrial Index. The idea with the strategy here is that all of the stocks in the stock market are moving in some sort of cycles. And when you're buying in these huge stocks, the Dow Jones stocks, the idea is that the risk of one of them going bankrupt and just disappearing is next to none. Of course they can do it, but before they do that, they would probably be getting smaller and smaller and drift out of the Dow Jones index. So the 30 stocks represented in the Dow Jones index are quite solid stocks, and they are analyzed by a ton of analysts from all over the world, the cleverest mind on these subjects in the world. So there would probably not be any huge surprises. So what you want to do is that we have the 30 stocks listed, and that's easy to find. You can find that on a ton of different websites. You can find the stocks, and we want to buy them as close to the bottom as possible. Of course we do, because then there's a very large upside. And the tool we use here are dividend payments. And I've not made a video about dividend payments yet, but there will be one. But shortly, a dividend is that the stock has money at the end of the year. They have some excess money, and they don't have any smart things to invest them in, or they have made the investments they need. So they pay out the money to the owner of the stock, saying, hey, here, this is actually your money, and we don't have anything reasonable to put it into, so we will just pay it back to you as shareholders. All right. So what we're looking for here are, we have 30 stocks, and we want the 10 stocks with the highest dividend yield. A dividend yield is a percentage. It's measured in percent, and you're taking the price and you're taking the number of dollars you're getting in dividend. Let's say, for instance, that the stock is worth $100, and you're getting $10 in dividend. Then $10 of 100 is 10%. So the dividend yield for that stock would be 10%. Maybe you have another stock in the Dow Jones that is also worth $100, but they are only paying out $2 in dividend. That would make a 2% dividend yield for that stock. So what you're going for here is you're going to choose the 10 stocks with the highest dividend yield. There are two reasons here. One of them is that when they are paying out dividend yield, a high dividend yield, you are actually getting money in your hand. So if you bought the stock for $100, then you're getting $10 in dividend, meaning that the first $10 the stock falls in price over the next year, you have them secured because you have money in your hand. There is a historic tendency that high yielding companies are actually better performers in the stock market, but that's an entire different story. So what you're doing is that you're choosing the 10 highest yielding stocks. The other reason for that, other than you're getting money in your hand, is that the stock that have high percentage yields are often the stocks that have dropped most in price. Let's say, for instance, that you have the stock worth $100, giving you $10 in yield, meaning 10% in yield. You have $10 in dividend, and that is a yield of 10%. Let's say, for instance, that just before you bought this, the stock dropped, so now you can buy it for $50. but it is still paying $10 in dividend. Now, what you're actually getting is not 10%, but it is 10 divided by 50, meaning that is 20% in dividend yield. I hope that makes sense. So the more the stock has dropped and still paying the same dividend, the higher the percentage yield you get. So what we want is that at the last day of the year, the last banking day of the year, the market has just closed, it's time for New Year Eve soon, you're pulling up your stock list and you are finding a list of the 10 stocks in the Dow Jones Index that is having the highest yields, dividend yields. And that's it. The first day the market opens in the new year, you're calling your broker or you are entering your online broker and you're just buying. If you have $100,000, you are giving 10% to each. So you're buying for $10,000 in each of the 10 stocks. And then you do nothing. You just lean back and you wait for a year. You don't do anything. Maybe you don't even watch the stock listings. You just sit down or go to work or enjoy your free time. And then after a year, you take a look at the list and you see how has the stock performed. And then you sell them all. Unless, of course, that some of them you should keep them, but due to the strategy. But otherwise, you just sell them all. Take the list and see which 10 out of the 30 Dow stocks are now giving the highest yield, and then you copy the exact same procedure. That's it. So you're buying relatively low price stocks, paying you a high dividend yield, and hopefully being in the bottom of their business cycle over the next year, they hopefully rise in price and you get a good return. And you don't have to spend your entire life in front of your computer, watching screens, reading news statements, thinking about is the new CEO the right man for the job. All of that stuff is completely out of your head, or it should be anyway. This is rules. You are simply just looking at the 30 stocks, picking the 10 with the highest dividend yield, holding them for a year, and then repeating the process. That's it. Does it sound a bit too easy? Well, it is built on some good solid foundations, and it has been tested live over the last 20-30 years, something like that, with some quite good results. I cannot guarantee that it'll keep performing well. I'm not a financial advisor, but it is a rules-based strategy, and if you have seen that every year you are investing as a private investor that you are underperforming the market, then this might be even better than your present strategy. Especially if your strategy is something about gut feelings and rumors from your neighbors and so on, then I can guarantee you that over the next 5 or 10 years, doing this strategy instead of just reading the papers and investing from your gut feelings, then this strategy will outperform your former performance anyway. And over time, it will probably also outperform the general market. Now, this is the end of this video, but in next week, I'll make a video number 2, the sequel to this one, because I'll give you 2 variations of this Dogs of Dow strategy. So you can choose if you want something that is a bit more aggressive and risky, or if you want the really laid back conservative style like this. So the sequel to this video will be 2 variations of the strategy, but even though you missed that video, you can easily go on with this strategy. Remember, subscribe to the channel, like the video, hit the bell notification, all that stuff to make sure that every time I come up with a new video, you get a notification in your YouTube messenger board. So that's it for now. Dogs of Dow, read about it. There are a lot of web pages out there about it. Read about it, take care of your money, and remember, the decisions are only your own. I'm not a financial advisor, so you risk your money on your own game. Alright, that's it for now. See you soon. Have a nice day.